Imagine you have 10,000 rupees. Now you can invest those 10,000 into stock, gold, bonds, commodities, mutual funds. But firstly, it's very important to understand the nature of the financial instrument that you are investing in. So in my today's video, I'm going to simply explain all the major types of financial instruments that are traded on stock exchange. Now you can compare those financial instruments as vehicles for money. Some are slow, some are fast, and some can even crash. So it's very important to actually know where your money is going into. If you are new to my channel, my name is Aman, and in my channel I break down financial concepts into simplest way possible. So if you are someone who is interested in finance or wants to learn more about the topic, then I believe that this channel might help you. Now without wasting any further time, let's just start the today's video. So firstly, let's just understand what are cash instruments. So cash instruments are those instruments whose value is directly determined by the market conditions, and they can be readily bought and sold. Some of the notable examples are stock, bonds, and deposits. So the first are stock. So stock represents your fractional ownership in a company. So when you buy a stock, you are buying a small part of a company, and the person who buys the stock is known as shareholder. For example, you purchase the stock of a company A. Now you are becoming a part owner of that company. So when the company performs well, your money increases, and when the company performs bad, your money decreases. Now the next are bonds. So bonds are slightly opposite of that of stocks because you lend your money to the government or either a company. Now bonds are usually considered as a safe investment because you earn a fixed rate of interest, but the returns are however lower than that of the stock market. Now we move on to fixed deposits. Now fixed deposits are usually considered as one of the most safest instruments because you give your money to the bank and in return bank gives you a fixed rate of interest. Some notable advantages are very low risk and predictable return, but however there is one disadvantage of fixed deposit is that inflation can eat up your money. That means that money will be decreasing in its value every year. Now one of the most talked about financial instrument in last couple of years are mutual fund. So this is where the most new investors usually start their investment journey. So if you are not a stock expert and you don't know which is the correct stock for you, then mutual funds can simply do it for you. You give your money to a professional fund manager who invests in stock, bonds, and commodities on your behalf. Now there are different types of mutual funds: equity mutual funds, debt mutual funds, and hybrid, which is a combination of both equity and debt funds. Now what are commodities? Now commodities are one of the oldest form of investing, and it usually refers to physical goods like gold, silver, oil. Now it is very important to note that now you are not investing in any particular company. Now you are investing in the value of that good itself. People usually invest in commodities to hedge against inflation because it also provides safe haven during the times of uncertainty, and it provides diversification to your portfolio. Now some of the important things to note about commodity is that commodities are one of the most riskiest financial instrument because it depends upon the external market conditions, be it economy, war, etc. What are derivatives? Now derivatives are types of financial instrument that don't have their own value. Their value is usually derived from something else, be it stock, gold, or index. For example, if you believe that a price of the stock would be going up in the future, now you don't directly purchase that stock, you are purchasing the contract of that stock. Now that is a derivative. There are two types of derivatives: future and option. So a future is a contract to buy or sell something at a future date at a fixed price. It is usually used by traders. An option, here's where the things get interesting. Now option basically gives you the right but not an obligation. That means that you can buy something if you want to, and you can also leave if you want. Now derivative is not an investment vehicle. It is usually an advanced level of trading because chances of you losing your money is very high. Personally, I would not recommend it to anyone. So lastly, now to summarize our today's video, choosing the right financial instrument depends upon a lot of things: your investment goals, your income, your risk appetite. So now you know that most people don't lose money because of the bad market. They lose money because they don't fully understand the financial instrument that they are investing in. In my next video, I'll be showing you how to analyze a stock. Till then, see ya, stay tuned.